Good morning, everyone. This is Sakis Paraskevov, Senior Fundamental Analyst at IronFX Global, bringing you the morning comment for the 11th of January. China remains the epicenter of the markets. China's central bank set the daily midpoint rate for the yuan higher for a second day in an attempt to ease fears that it is trying to weaken its currency to gain a competitive export advantage. Nevertheless, the Asian equity markets continue to tumble and the carnage seems to have no end. The recent yuan depreciation and the recent weak economic data added to the possibility of more bad news out of China, and that it might be hard for the nation to achieve economic growth above 6.5%. Australia and New Zealand, whose economies are heavily dependent on exports to China, saw their currencies weakening further. Now, the focus shifts on the Chinese trade data to be released on Wednesday. The dollar pared gains as worries over China kept demand for safe haven investments intact. Despite the strong U.S. employment report, Nonfarm payrolls increased sharply in December, beaten by farm market expectations. Even though the jobs report seems to be solid, the flat average weekly earnings point to weak inflationary pressures. The minutes of the first December meeting show that the debate over the outlook for inflation will be crucial to determine the future path of rate increases. If the inflation data going forward do not improve, the Fed may hold off on rate increases. As a result, we will need strong data going forward to give the bulls a good reason to buy USD back. Elsewhere, the South African rand collapsed at the opening on Monday, falling more than 10% against the dollar. The move was most likely flow-driven, as the lack of liquidity outside the major pairs and position liquidation hurt ZAR, which has unwound most of the move during early European morning trading. Even though today's move was not based on fundamental reasons, the currency continued to make new record lows against the dollar as global markets trembled in response to the deepening turmoil in China and other major emerging market economies. As for today, Norway's CPI rate for December is expected to have slowed slightly to 2.7% year-on-year from 2.8% previously, but to still remain above the Norges Bank target of 2.5%. The bank has shown no significant concern regarding the level of the inflation, as it is mainly attributed to the weak NOK. Therefore, market participants are most likely to watch the oil prices as a proxy of the krone's near-term direction. From Canada, the housing stats for December are due to be released. As for the rest of the week, the spotlight will be on the Bank of England monetary policy meeting on Thursday. No change in policy is expected, while consensus is that the vote will once again be split 8-1, with Ian McCafferty to maintain his call for a rate hike. The minutes of the meeting are released at the same time as the decision, which makes meeting days more interesting than before. This gives us the opportunity to get additional insights about members' view on the UK economic outlook and future decisions, especially with the Brexit referendum looming, and sterling testing its lowest levels since June 2010 versus the dollar. On Tuesday, we get the UK's industrial production for November. Expectations are for the industrial output to have remained flat, a slowdown from October's minor rise. The construction and manufacturing PMIs for the same month were not particularly encouraging. As such, we see an increased likelihood for a soft industrial production figure, which could weaken GDP at the release. On Wednesday, as we said before, China's trade surplus is forecast to have narrowed somewhat in December, with imports once again expected to have fallen at a faster pace than exports. Both imports and exports are also expected to fall faster than the previous month, reflecting sluggish domestic demand in the world's second largest economy. Since Australia and New Zealand are heavily reliant on exports to China, the rapid fall in Chinese imports in particular could put Aussie and New Zealand dollar under renewed selling pressure. On Thursday, besides the Bank of England meeting, Australia's unemployment rate is expected to have ticked up a bit in December, after printing 2 consecutive months of solid employment gains. Even though we would expect overall employment to have remained supported due to the holiday season demand, if the forecast is confirmed, it could weaken Aussie a bit on the news. On Friday, the US retail sales for December are expected to have slowed from November. Nevertheless, due to the December holiday period and the low energy prices, we see the possibility for a higher than expected reading. This could encourage USD bulls to add to their positions. For more information, including technical analysis, please read the full comment on ironfx.com or download our app and get all the information you need to trade delivered directly to you. And also, follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Sakis Paraskevov, Senior Fundamental Analyst at IronFX Global, wishing you solid trading.